Welcome to AVC Learning Solutions. My name is Amit Chawla, and in this discussion, we would like to talk about the classification of financial assets, specifically onto when I'm using a financial assets classification under amortized cost method and the classification under fair value through other comprehensive income, which is FVOCI. Right? We would like to discuss in this particular section in terms of how does the change in accounting happen when you are using these two classifications and for let's say one category of a financial asset. Okay, let's talk through it like this. Say I have made an investment in a bond which has a term of 3 years. My investment is let's say 98,000. And my realization or maturity amount is 100,000. All right, and I'm saying that my annual receipt of interest is, let's say, 5,000. So essentially we are saying that I had this investment available at a 2% discount and my interest rate is 5% per annum. Now what we need to understand here is that either it's amortized cost method or FVOCI. In both the cases, we need to assess what is the effective interest rate that we receive, right? Something which is your IRR, or as in this case we say it's EIR. Now let's say if this were 100,000 and this is 100,000 as well, and I'm receiving 5,000 plus 100,000 every year. So by default my interest would also be my effective interest rate, or of course my internal rate of return. But since my investment is lesser as compared to my maturity amount, I'm sure to receive more than 5%. Right? So effectively my investment is 98 on which I'm getting 5 each year, and then there is a maturity amount. So what we are trying to say is that we first need to calculate what is the effective interest rate here. Now of course, using tools, using Excel, it's quite straightforward. It's a click of a button and you get the answer. But here we are just trying to use a very a conventional approach where we look at the trial and error method, where we say that let me try to assess what are my cash flows, and if I were to discount those cash flows, what would be the discount rate at which those cash flows are equal to the present value of this amount, which is 98,000, right? That is something which is my internal rate of return. So when I try to do that, the easy pick would be, I'm saying, look at my cash flows, which is year 1, year 2 and year 3. Year 1, I'm supposed to receive an interest of 5,000. Year 2 the same, but year 3, I do not only receive 5,000 as my interest, but I also receive the principal amount in maturity, right? So when I have this particular figure in front of me, I'm saying that let me use a discount rate of 5% here, and I'm saying that at year 0, my outflow, which is my initial investment, is 98,000, right? So at a discount rate of 5%, I'm saying my NPV should be, the present value of these cash flows should be 98,000 as it is, 5,000 divided by 1.05 to the power 1, 5,000 to the power 1.05 to the power 2, and 105 to the power 3. Okay, and I shall get my answer in terms of what is the NPV. But then if I do this calculation, ideally it should be 2000 positive, considering the fact that these three cash flows, 5000, 5000 and 105, taken at a discount rate of 5%, ideally should result into a present value of 100,000. So let's try to do that as well. We're just doing a longer way to do that. So this value comes at 4762. Okay, I'll divide it further by 1.05. This gives me 4535, and then I have 105 divided by 1.05 to the power 3, and that gives me, of course, 90703. So 90703 plus 4535 plus 4762 has to be 100,000, and against that I take a negative 98. So this gives me 2000 positive cash value, the present value of that. Okay, so I have got this value at 5%. So automatically, or I would want to now use a higher discount rate, okay, to assess if I get an NPV which is negative. So let me do one thing. Let me take another rate, 6%. I could have taken 7% also, does not really make a lot of difference. But if I use 6% now, so essentially to use some space wisely, I'm saying that at 5%, so NPV at 5% is positive 2000 here. Okay, but then if I were to do it at 6%, I'm saying this is 98,000 as it is, year 0 cash outflow. The present value has to be the same. This would be 5000 divided by 1.06 to the power 1, then 5000 divided by 1.06 to the power 2, and 105 divided by 1.06 to the power 3 here. Okay, and when I do these calculations, I'm saying this comes at 4717. Okay, and then I have 4450, and then I have final figure which is 88160. So when I add them up, 88160, 4450 and 4717, but minus 98,000. This comes at a negative figure of 673. Okay, so safely we are using a trial and error. We did the discounting at 5%, which is certain to give a positive cash flow, and then we took a higher discount at 6%, which actually gives us a negative present value or negative cash flow of this entire calculation. So what I'm trying to say is that my IRR would fall somewhere between 5% and 6%. Okay, right? Now believe me, these are all straightforward calculations on these tools. The basic tools will do these calculations straight away. We're just doing it so that we understand the entire logic around that. And so let's do one thing. Let's use these numbers, minus 2000 and 2000 and minus 673. We are saying that the IRR is the lower rate plus present value at higher rate divided by present value at higher rate minus present value at, so this is a lower rate, of course. So it's a positive NPV we're talking about, so it has to be a lower rate. So present value at lower rate minus present value at higher rate multiplied by difference in rates. Okay, so when I plug in this value, my lower rate is 5%. Okay, my present value at lower rate is 2000. This is 2000 minus of minus 673, which becomes obviously positive 673, and the differential is of course 6% minus 5%, that is 1% here. So when I do this calculation now, we are saying 5% plus, considering 1% here, divided by 2673. And when I do this calculation here now, that is 20 divided by 2673. That gives me an approximate rate of 7.48. That means my actual internal rate of return or effective interest rate is 5.748. Okay. Now this is something which is clearly identified. So I'm saying that my effective interest rate is 5.748%. How do I use it in terms of accounting when we do the classification of this investment under amortized cost? Okay, let's quickly have a look at that first, and then we want to check the same from an FVOCI's perspective. We are saying that my investment is 98,000. Okay, so if I were to create a chart here, I'm saying my opening balance year 1, year 2 and year 3, this comes at 98,000. My interest income at 5.748%. This comes at 5633. Okay, minus the cash flows received, which is of course 5,000 here, right? So essentially we are saying my closing balance has to be this plus this minus this. Essentially I'm adding 98633 as my value. That becomes my opening value for the next year, and on that I calculate the interest income at 5.748. So this is my income, this is my receipt, this goes to P&L, and this goes to of course my balance sheet there. So when I look at this figure now, 98633, I take the calculation at 98633 multiplied by 5.748, that comes at 5669 here. Okay, I'm just doing the calculation check once again. 0.05748. Yeah, here we go. So it says 98633 plus 5669, but minus the cash receipt, which is 5,000. So I have 98633 plus 669 as an incremental value. So this gives me 99302. Okay. Year 3, 99302 becomes opening balance, and on 99302 I do this multiplication, which now comes at 5708, and of course I receive this interest of 5,000. So when you add these up, 99302 plus 5708, this is the approximate figure to me, which is 100010. This is purely a round off difference, because this value has to map up with that other value. So what I can do is, in terms of my accounting, I can even say this is 5698. Since the differential is minimal, I'm using this value 5698 as my income. So 99302 plus 5698, that gives me 105000 minus 5000 would result into accounting for the final value of my investment, which is 100,000. And at this time, I recover my investments, right? So the way I do the accounting here, we look at the journal entries now, and we are saying that initial investment for this particular transaction, my entry is debit investment, credit bank, which is 98,000. Okay. For this particular item, I'm saying debit investment, I've earned a higher value. Credit interest income, which is 5633, right? But then when I recover this amount, I'm saying debit bank and credit, it's a realization of my investment here, which is of course 5,000. All right. So this is something which I do every year. So this is my year 1. In my year 2, my investment income would rather be 5669. This would remain the same, right? In my year 3, I'm saying my investment income is now 5698, and this would remain the same as well. Okay, so this is the accounting that we do when we are following the amortized cost concept here. Okay, but then how do we deal, or how do we do the accounting when the classification is under fair value through other comprehensive income? Now, please bear in mind, when we say FVOCI, we are simply saying that on each reporting date, right? At each reporting date, the investment is required to be shown at its fair value. All right. So when it is to be shown at its fair value, then the change purely arising on the fair value should be taken through OCI. Is it okay? And that is where we start recognizing the differential part of it. We need to track that what is that fair value differential which is arising purely on account of interest, because the interest has to go to the P&L, and anything else causing that change in the value of the investment has to go to the other comprehensive income. Okay, so let us say, for the sake of understanding, that the fair value of this investment, okay, the fair value of the investment at the end of year 1 is 97,000. Okay, and then we are saying the fair value at the end of year 2 is 101,000. All right. So when I say I'm looking at this 97 and then 101, I need to assess what is the accounting that I'm supposed to do in this particular instance again, right? So we are saying that when you have got this calculation done in front of you, okay, precisely, so let's use this space a bit again. So here I'm saying that my calculations are quite straightforward here, which is not very challenging in terms of above calculations also, but there is a gap which arises purely because of my OCI movement. Alright. So what I intend to say here is that when I look at my calculation, okay, when I look at my calculation here, that the fair value of the investment is 97,000, it's a good idea to do the calculations again so that we are maintaining, we are able to manage that, information fairly well. We are saying that when I have my investments shown at 98,000 to begin with, all right, so precisely my closing figure for year 1, right, so these are the fair values, okay, my value under amortized cost method in year 1 is 98. So let's use this space even bigger. So year 2 end is 101,000. So I'm saying that value under amortized cost is 98,633. Okay, and year 2 it is 99,302. Right? Of course, year 3 we say the clean price of both the investments as per fair value and under amortized cost comes at 100,000 here. Okay, just for the sake of understanding this better. So essentially my accounting goes the similar way, but now I'm saying that due to a change in my fair value, okay, due to a change in my fair value, there is a reduction in my investment value at 1633. Okay, so when I do this accounting, I'm saying my initial investment accounting or my accounting was 98,000. Okay, then I'm saying that debit investment 5633, credit interest income 5633. Okay, and then I'm saying that debit bank credit investment. So this is going exactly the same way, which is 5,000, but against this 98,633 I'm supposed to show this value at 97,000. That means what? I need to create an OCI loss to the extent of a differential of 1633 and reduce the value of my investment to that extent. Okay, so from 98,633 now I show it up at 1633. Okay, right? Same ways when I move on to my year 2. Okay, when I move on to my year 2, I'm saying that my interest income is 5669. So this is the same accounting treatment. 5669 comes in. This is same, of course, but now the value of your investment is 101,000. Okay, and when it is 101,000, you need to recognize the gain in your books here. Okay, and how do you recognize that gain? We are saying that you reverse the original loss and you also recognize a further gain in the books. Okay, so effectively what we are saying is you bring that cumulative change so far with respect to the fair value differentials. Okay, so let's start to even do that calculation right away. We are saying in the year 2, I would showcase a gain of, so let us say, let's do these accounting. 5669 has come here, 5000 would come here, but against my value of, so my opening balance, if I were to, let's say, look at that, I'm showing this value at 97,000, right? So when I did this accounting, so my opening value of my investment is 97,000, okay? And then I recognized an interest income of 5669. Okay, so this would be added, of course, to my investment value. Then I received 5,000 back. Okay, so effectively I have the value of 97,669, but I need to show this at 1,000. Okay, so what I'm trying to say is that in this case, my gain to be reported shall be 333.1. This is my purely fair value differential. So the way I do the accounting here is that for my year 2, so let's do one thing, let's do all these calculations again. We are saying in my year 2, my debit investment 5669, so is this value, of course, right? Credit interest income 5669. Then I have debit bank recovery of your investment, which is 5,000, of course. And then I'm saying debit investment credit OCI, which is your 333.1 here, right? And finally, when I look at my year 3 calculations, which is 100,000 to 100,000, I need to understand what is the change that has come now, right? Essentially, I'm showing my year 2 investment value at 101,000. Okay, I add up 5698 to that. I reduce 5,000, so that gives me effectively 101,698. I need to bring it down to 100,000, which means that I need to bring this as my OCI differential. Okay, so when you are done with this kind of accounting, you are able to conclude that the classification would also impact your financials directly or indirectly, right? So just to quickly kind of conclude these things, we are saying that if I've got this accounting done under amortized cost method and this kind of schedule is prepared, okay, I use the schedule here for my FVOCI also, opening balance, interest at the rate 5.748%, receipt, okay, so my closing balance as per fair value, right, and the differential which is going to OCI. Let's try to use it like that. So I'm saying my opening balance at the end, at the start of year 1 is 98,000. This is 5633. I receive 5,000. So let's do one thing. I'm saying the balance is this, but the fair value is this and delta. Okay, so this would have been 98633. Fair value was 97,000, which means a reduction of 1633. Is it okay? Right? Now what we are saying is, we go to year 2 and then we do the same calculation like this. essentially, which is 98633. Then we say 5669, 5000. This gives me a value of 99302, but I need to show it at 101000. That gives me, of course, plus 3331, something I remember. Year 3, my balance again goes to 99302, and I say 5698 minus 5000. So this gives me a value of 100,000 here, and since my delta would be nil here, whatever changes which are coming in should be reversed in my books in that particular direction here. So that is how you start recognizing the accounting for your financial assets investments when they're done through amortized cost versus when they're done through the FVOCI. Right, so that's from my side, and thank you very much for this discussion, and have a good day. Take care. Good luck. Bye.